Introduction. Welcome to the recap of key concepts. Over the past modules, we've covered essential foundations of trading, helping you understand markets, analyze charts, and manage risk. This recap will reinforce the most critical points, ensuring you feel confident as you continue your trading journey. 1. Market fundamentals. Understanding markets. We explored the three primary markets: stocks, Forex, and crypto, each with its own dynamics. Key takeaway: markets move based on supply and demand, economic events, and investor sentiment. Types of traders: day traders, short-term trades; swing traders hold for days or weeks; long-term investors focus on growth over months or years. 2. Chart analysis. Reading price charts. Candlestick patterns reveal market psychology. Bullish patterns like the hammer indicate potential upward moves, while bearish patterns signal declines. Recognizing support and resistance helps identify entry and exit points. Indicators. Moving averages show trends. RSI, Relative Strength Index, highlights overbought, oversold conditions. MACD signals potential trend reversals. 3. Risk management. Position sizing. Never risk more than 1–2% of your capital on a single trade. Stop-loss orders automatically limit losses if the trade moves against you. Risk-reward ratio. Aim for a 1:2 or higher risk-reward ratio. Risk $100 to potentially gain $200. Key takeaway: risk management protects your capital and ensures long-term success. Conclusion and next steps. Trading isn't just about finding opportunities, it's about managing risk and staying consistent. As you move forward, practice in demo accounts, review trades regularly, refine your plan over time. By mastering these core principles, you're laying the foundation for a successful trading career. Happy trading!